Right, welcome to this episode of Real Estate Chat, sponsored by the Bank of Canada. No, actually, we're not sponsored by the Bank of Canada, but we are here, John Perez with,
Robert Eid.
and literally as we're shooting this, the announcement came out from the Bank of Canada. And what is that announcement, Robert?
Bank of Canada maintains policy rate, continues quantitative tightening. So there's two things in there.
And what are those two things? Like extrapolate on or expand upon
They
those two.
promised us a conditional pause, which is like a conditional offer. I can get out of it anytime I want, because I warned you that it was going to be conditional. And they're continuing the quantitative tightening, which means they're reducing the volume of bonds in their portfolio. Instead of rolling them over, they're letting them. Now somebody's got to buy them, so they got to find a place for them. So people have to bid on them, and so maybe it moves the price up a little bit. So nobody cares about that. They only care about the interest rate.
Right, so no doubt it's going to have a ripple effect on the media. You're going to see this here first. I'm going to try to put this episode up there, but social media, all realtors are going to be talking about this. Everybody's going to be talking about this. But the important thing to talk about here on Real Estate Chat, please click subscribe and like if you like this, dislike if you don't like the announcement. But the important thing we're going to talk about here today, Robert, is what bearing does it have on somebody buying, selling real estate, anybody in real estate? We're going to load up. Let's go.
Yeah. Okay, so if the interest rate stays flat, is this what we expect? Is this increase our willingness to do something, get off the fence, or does it increase our hesitation to do something? So we can only say that we don't know, because we've just had the February results on prices, which show an uptick. Now, it's an uptick that's completely in keeping with the last 22 years, which go up from February to January, 6%. This went up 5.5%. So it's almost the same. It's a lousy time, so it's almost the same. So nothing special happens every year. Don't read too much into it. Next month is going to be the same price again, because that's what happens every year. So we know that the volume is based on interest rates. People will do nothing if they don't like the interest rates, because they don't want to make the payments. They'll stay where they are. So did the Bank of Canada do anything, or did they do nothing? And did not doing nothing, is that good? So it's not bad. It's not good. So the key question for us is the Bank of Canada following or leading the Bank of the Federal Reserve? And why are they behaving in the way they're behaving? All of these guys are trying to out Volcker. What they've got to finally do is acknowledge they're never going to get back to 2%. The reason we have inflation that got to 13% is because of what they're doing to gas prices. This crazy idea of climate change, they're now hating fossil fuels. Oil does not come from fossils. That's nonsense. There's no scarcity. Quit doing this. Quit pushing electric vehicles that there isn't enough power to charge overnight.
Okay, let's get into your charts. Let's talk about real estate. So let's load up on screen here, Robert, what you prepared for us this morning. And in the sense of the context of the interest rates are remaining the same. The previous interest rates have been hiked up, like to the point that we're at today, 4.5%. Mm-hmm. And so what is that going to do to prices? And why don't you explain that visually here?
Okay. So this is based on what do we guess the future is going to be? And we give 3 or 4 scenarios. One is, what if prices continue to fall by 1%? What's going to happen to the end of the year? Did it for another year, but that's too far out to guess. So far but you can see the big, from you go to the peak, 1.334, down to where we are now, a huge drop immediately. So we won't having another huge big drop like that, because that was the boom and the bust. And so now what are we going to do? We're going to wiggle along flat. So the average of the whole thing was around 2%. So what's going to happen to prices if they go forward from now at minus 1% a month? We're going to lose. Right now, we're at minus 17. We're going to go to minus 25, near 26. So we're going to lose another almost 10%. If we go down 1.5%, we're going to go down a little bit more than 10%. That's from the original. Okay, that's from the original 1.3. That's the 10%. And if it goes down 2%, which it probably won't, like every month, it's not going to go down 2%. So are prices going to go up until interest rates go down? No. The whole reason we have a bad market is the specs are gone, the first-time buyers are gone, and we got a very cautious trade-up market where, yes, you've got a few estate sales. Yes, you got a few last-time sellers. People are cashing out. But the trade-up market is only someone who finds something that's to their advantage. So that's why you only got 40% of a regular 10-year average in sales, is because everybody is doing nothing. So when everybody's doing nothing, prices are not going up.
So you're saying that this non-eventful announcement today, which was expected, which, if you watch several episodes back of Real Estate Chat, we were talking about this policy when January was announced. The prices are just going to wiggle. They're not going to go up. They're not going to go down. And when we say up or down, I mean, obviously they go up and down notches, but they're not going to make any major moves as a result of this announcement.
Correct.
Yeah. All right, then let's look at this.
Okay, now this is an old chart. Finally, on March the 1st, I redid my 2023 inflation, and it got very complicated, and I had to do 7 charts and how they affected it. So this is the January one, and this is, again, the inverse relationship between interest rates falling and prices going up. So we'll see again when I get this redone to include February, and maybe bring a prediction for March of where interest rates might be an influence. But right now, we're nowhere. We saw interest rates a little bit higher, like the 5-year announced rate is still the same, but you're able to get a discount rate for less than what is announced. And that's really what we're monitoring, is what is the discount rate for 5 years following, and these are annualized numbers of prices. So again, we are trying to figure out where we are. Are we in the edge of a precipice? Are we in the edge of a long road out into the future that we can't see the end of it, but it's just, it's like a flat road in the desert, right? The Bank of Canada is responsible for dropping the rates too low at the time of the fear of death lockdown. Low rate lockdown is what we had. And during that time, people responded by, oh, I have 2% inflation and 2% interest. I'm going to buy something speculative. And because, your money wasn't earning anything in the bank, so it's going to a tangible asset. So they bought real estate. Guess what happened? The prices went crazy. Now they don't like it. And as I said earlier about the price of energy being a huge component of the inflation that they're seeing, forget about getting down to 2%. Aim for 4%. Announce that interest rates are going to come down a tiny bit, and let's get back to business.
Now, when that happens, Robert, how far? I mean, obviously you don't have a crystal ball, and you're very good at forecasting these prices, but let's say we're at 4.5. Let's say the day comes, whether it's end of 2023, beginning 2024, like everybody's been buzzing about, we come back to 4.25, 4%. Do you see prices coming back to peak February 2022?
Okay. I was referring to the rate of inflation. Okay. Not 2% mortgages, 2% inflation. These two idiots in the state and here have 2% inflation in their head. You're not going to get there. You're not going to get there until you do something with oil prices. They're not going to do anything about oil prices. It's entrenched. So house prices are going to wiggle along somewhere between 80% of what it was in the peak and 70% of what it was in the peak. We've got that on the chart over there. And don't worry about it. Again, you're going to have to pick your spots. Sales are going to be low. There's going to be noise in the spring. Okay, in the spring, everybody gets a new car, gets a new girlfriend if that's appropriate, and gets a new house if that's appropriate. It's just spring fever. Spring is the spring, the summer is the summer, the fall is the fall. And again, why I hate HPIs, because they try and make the September equal to January. They're not. There's a season to it. So, was this announcement important for doing nothing? No, it's not. But they could have done something. The Americans are going to do something. The Americans are threatening to do something. And so our people are pulling back, just like the stock market pulled back. Everybody's anticipating the worst case scenario rather than rosy hope. So doing nothing wasn't bad, but it wasn't good. Is that a conclusion?
All right. And on that note, this episode again was not sponsored by Bank of Canada. If you like what you saw here, click like. If you dislike it, click dislike. If you dislike the announcement, it's okay to click dislike as well. Wasn't our announcement, not our policy. So make sure you subscribe, leave your comments about what you think about this interest rate non-eventful announcement. And we'll see you in our next episode of Real Estate Chat. Bye for now.
See you later.